Good afternoon. My name is Joseph Litchauer, and thank you for taking the time today to join us on this webinar in our series, A New Era of Equity Income. Today, we'll be hearing from Julian Kane, the lead manager of CT UK Capital and Income, ticker CTUK. And Julian has been managing the trust since 1997, and over that time has really focused on building a portfolio of quality stocks that he believes can help deliver that long-term capital and income growth to investors over time, but with a particular preference on identifying those that can grow their dividends in the future. So before we pass over to Julian, for those not familiar with the format, I'll just quickly run through what to expect today. Julian is going to be presenting on the trust for around half an hour or so, and that will leave us with a good amount of time, 15 minutes at the end for Q&A. So if you do have any questions that you'd like me to put to him, please just pop them into the Q&A box on the bottom right hand of the screen, and we'll get to them at the end of the presentation. So with that, Julian, it's my absolute pleasure to welcome you today. Please take it away.
Good afternoon. Thank you, Joseph, and thank you everyone for joining us today. So today happens also to be the day of the year that we announce our full year results for CT UK Capital and Income. So I'll focus on those a little bit to start with, but with a particular focus on income. So hopefully that will give everyone a little bit of a feel for how we run the fund and the importance of income and capital also in what we do. So Joe, if we could move to slide 5, please, the first couple of slides there later for people to have a look at if they want. So I have managed the fund, which is now called CT UK Capital and Income, since March of '97. It started off when I was with F&C and then BMO, and has now become CT, but same fund all the way through since '97. We are primarily an investor in UK companies. We're looking to try and find the best UK companies we can, with an intention of growing both their capital and income over time. And ever since launch back in '92, we have consistently increased the dividend each and every year. So that gives us dividend hero status from the AIC. We pay our dividends quarterly. We believe that's what shareholders want. That's what they tell us. And we also pay those dividends at quarter ends, which makes budgeting that much more easy for people who receive those dividends. Of course, one of the technicalities of investment trusts is that as companies, their share prices and their asset values can and often are quite different. But as an investment trust, we've long held the view that because we are investing in liquid mainstream UK companies, we have a liquid portfolio. So there's no reason why our asset value and share price shouldn't be close together. So we've had a long-standing share buyback and share issuance program, which has made sure that those two stay together. If there's one thing that shareholders really don't like, it's when shareholders experience the share price is quite different to the asset value, which the fund manager hopefully manages to grow over time. We try to minimize that by making sure that the share price and the asset value are close over long periods of time. If we can move to slide 6, we'll just touch on the agenda for today. So I'll talk briefly about the results. Then we'll touch on why we firmly believe that valuations matter, both in investing in the UK market and more generally. We'll highlight why we think UK equities are abnormally good value, and then we'll touch on the outlook for the year. So slide 7, please. And we'll touch on the highlights for the year. So the year through to 30th September 2024, the all-share index actually had a pretty good return, 13.4% over the year. And pleasingly, our own NAV, net assets per share, increased by 18.4%, so a useful 5% outperformance of the index over the last year. And as well as the capital return being strong and ahead of the index, we also are able to announce our 31st consecutive annual increase in dividend. CPI over the last year has come down from the higher levels that it had been in previous years. So CPI, basic inflation rate, just 1.7 over the year. Our own dividend increased by 2.9. So again, a nice little increase ahead of our benchmark. I mentioned that we try to keep the NAV and share price close together. This year, the share price was a little bit behind the NAV, but still a very good absolute gain of 16.6, which obviously is ahead of the all-share index total return as well. So the shares ended the year at a discount of 2.9%, having averaged 3.8% over the year. So a small difference between the NAV and the share price, but not really all that material. Putting this into graphical form on page 8, we can see how those have progressed over time. So start of last year, there was a bit of a dip in the market, but actually since then, it has been reasonable progression throughout that period. And on page 9, we look at performance over 3 years, which unfortunately shows a little bit of a different pattern in that the asset value and share price have underperformed the index over that sort of short to medium term. And really all the damage, all the underperformance here was in the year through to September of 22. Whereas, well, people will remember, of course, that was the year that interest rates started to rise and started to rise spectacularly with the mini budget in September of 22. Having 4 chancellors over the course of that year certainly didn't help our performance at all either. But since then, we have been doing our very best to catch up. And if we look at page 10, if we focus on the longer term numbers, then you can see that the asset value and the share price of the fund has been usefully ahead. So there have been periods when we have underperformed the index, but actually over the longer term, these come out in the wash. The good years have more than outweighed the more disappointing years. So that's the total return. On page 11, we can start to look at the income experience of investors over this time. So the chart here looks at the income that a shareholder or an investor would have received from 3 different possible investments. The line going across the page is what they would have received from putting £1,000 into a savings account that gave them the bank base rate. So you can see from 92 for the first decade or and longer, actually just having your money in a bank account would have given you more income. This is just focusing on income, not capital. Would have given you more income than a stock market investment in the all share, which is the other investment, or in CT UK. But of course, the power of compound interest being what it is, the stock market investment, where you've got the ability to grow capital and then to grow income from your enlarged capital, has led to significant gains the longer you hold it. And you can see that CT UK would have given a very substantial £2,500 income on that £1,000 investment. So that would have been a really attractive return, and certainly well ahead of what you would have got out of the all-share index, and obviously more than you would have got out of the savings account. Of course, the savings account would still be worth £1,000 at the end of it, whereas our asset value has increased well, multifold over the period as well. It's also hidden within the chart, of course, is also the fact that an investor in the all-share index would have suffered a number of dividend cuts over the period. And here I'm thinking of the period, the technology, media and telecom boom and bust of 99 through to 2002, or you could think of the global financial crisis in 07, 08, or more recently you could have thought of the COVID years. Each of those 3 periods, the dividends from the stock market as a whole, from the index, were cut in response to the adverse conditions. By contrast, we have increased our dividend each and every year. So that allows us in those more difficult years for the index as a whole, really allows us to differentiate ourselves and to keep our record of growth going. So that's one way of thinking of our dividend progression over time. But page 12 sets it out in terms of growth relative to inflation. And our first dividend way back in 93, it was 3.4 pence per share. For the year just announced, it's now grown to 12.5. So that's dividend growth of 267% over that period. And it compares to CPI growth of 106% over that period. So you can see we've materially outstripped inflation over that time period. So we feel that's an attractive proposition for an investor with a long-term horizon who's looking to protect against inflation and also looking for better dividend growth than putting in a bank account or in a more general stock market investment. On page 13, we just highlight some of those individual names that have contributed positively and those that also have detracted from performance over the last year. As ever, there are a number of companies which have performed exceptionally well. So even though the return from the stock market is pretty attractive and well into double digits, you can see that a number of companies have had really extraordinarily good share price performance. And it's worth highlighting that a couple of those were from the private market world. So Bridgepoint is a private equity investor, and Intermediate Capital is a private debt investor. And even though generally those pretty stuck in sort of a sense of stasis and not making much progress, you can see that the share price performance of those companies has really been very strong over the last year. In fact, Intermediate Capital is our largest shareholding at the moment. It's been a long-standing shareholder and has been a very successful performer. Also worth touching on the fact that DS Smith is being taken over by International Paper. That's also been a reasonably long-standing investment, and certainly we feel it's recognition of the fact that some companies in perhaps not desperately exciting industries are rather overlooked by the stock market generally, not necessarily by their peer group. So the peer group is recognizing the value in DS Smith, even though the stock market didn't. There's also exposure to building and house building companies in there, CRH, the building material supplier, Vistry, the house builder, and Ibstock, the brick manufacturer. Each of those benefited from falling inflation, which led to the expectation of falling interest rates as well. On the detractors side, I'm sure many people will have been aware of the trouble that Burberry Group has been suffering. A lot of this is coming from a slowdown generally in luxury goods sales. Burberry are not alone in finding that expenditure on luxury goods has come under pressure. But it's also more specifically because of Chinese slowdown. A growing proportion of their sales have been in China and the Far East. The appointment of a new chief executive at Burberry, we believe, will help to reinvigorate the business. There'll be some repositioning, minorish repositioning of the brand, and we believe that should be positive for its future. Likewise, the problems of Close Brothers have been pretty widely trailed in the newspapers. Motor finance is the area that has caused it most problem over the last year. I think it's fair to say those problems had not been widely anticipated, and hence the shock and the size of the move in share price. It's now one of our very smallest share holdings. We look very carefully to see what the Supreme Court will say if and when it agrees to hear the court, so the appeal from the lower courts. So we continue to monitor that very carefully. On page 14, we highlight here the balance of the portfolio. So although we are investing primarily in UK companies, they are truly international in where they operate and where they make their money. So the inner ring of the donut looks at the domicile of those companies. So you can see the dark blue shows the domicile of our investments is overwhelmingly from the UK. But if you look at the outer ring of the donut, you can see that the revenue that these companies generate is much, much more international. So although the UK is still the largest single country of origin for those revenues, the amount of revenue that is generated from the United States, in fact, is not that far behind. And if you combine that with Europe and other areas, you can see the majority of the underlying revenue from these companies in the portfolio is international. So yes, we are investing in UK-based companies, but it is a very international mix of revenue that comes from these. And we believe that that gives it much greater diversification benefits and puts us in a much stronger position than obviously if we have just focused on UK domestic investments. On page 15, we look at why valuations matter. And I think one lead into this might be perhaps the head-scratching moment that I'm sure many people will have had over the last week or so, reading about what happens or recent goings on in the contemporary art market. It certainly gave me pause for concern. And Comedian was the aptly named artwork that I'll comment on very briefly. So it is a banana, a yellow banana, fixed to a white wall with silver duct tape. It was auctioned and sold the truly incredible amount, US dollars 6 million. And why on earth would anyone pay $6 million for a banana? Well, in some ways the joke is on all of us, because it had previously been sold for $120,000. So anyone who bought it at that price and then sold for 6 million has arguably having the last laugh at the moment. But we are investing in productive assets. We're not trying to invest in areas where it's speculative, where it's guesswork, where you're relying on someone else to pay you more for something. We are investing in productive assets which generate revenue, cash flow, and ultimately dividends. And we believe that over time valuations do matter. We can't aim to guess whether a banana should be worth 25p as it is in a shop or $6 million. But if we focus on productive assets, think of the example of a bond, then it's very clear how the theory works. For a bond, we can predict precisely when we'll get those cash flows, and therefore the more you pay for the bond on day one, the lower the return that will be generated. It's a very clear relationship: high price, low return. With equities, it's less certain, of course. We don't have those that predictability that bonds do. But in practice, it would still be the case that a higher starting valuation is likely to lead to lower returns. But of course, with equities, some companies can perform truly exceptionally and fantastically over time. So it's arguably less true for individual companies than for a whole market, whereas a market is amalgamating all of these companies, some exceptional, some average, some poor. At a market level, the valuation has a very close correlation to future returns. And the long-term data, as we set out on page 16, is pretty clear for this. And if I just explain by focusing on the US chart at the moment. So if you had a starting PE ratio, that's along the x-axis of 40, there have been two such occasions using this data when the market has started with a PE of 40, and on the y-axis it plots what the subsequent 10-year return had been. So over one 10-year period, you've got a 5% compound return, and the other year more like 3. The purple line plots the line of best fit, and it's very clear that if you have a low starting PE, perhaps around 10, you would expect a compound return of 15%. And if you had a starting PE of 40, perhaps you'd expect a return of 2.5% or so. So very clear returns. And when you plot those against the starting PE ratios of today, you can see that it really should lead to some pretty attractive outcomes for investors. And on 17, we set out where the current PE ratio is for the all-share index at the moment, and that is below its average. So we're plotting here using data going back to 93, which is close to the length this trust has been going. So the average PE over that period has been 17.5, 18 times, something like that, and currently we're well below 15. So the PE ratio, all other things being equal, is on the low side. And for the dividend yield, we're also getting a bit more yield now than we would have done historically. So at a starting level, as of today, it does look to us as though company dividend yields are pretty attractive and PE ratios not too demanding. Interesting, though, to think about dividends and how those have evolved over time. And on page 18, we set out some thoughts there that there definitely has been an evolutionary shift. I think arguably starting to be triggered by COVID. At that stage, of course, a period of maximum uncertainty, people didn't know what the future would hold, and I think it was entirely sensible for a number of companies to withhold their dividends, to strengthen their own balance sheets, and to prepare themselves for the worst. So that, I think, did mark a break with previous practice that had suggested dividends were upward only. I think it also partly reflects the opportunity that exists. So companies are rightly thinking about how they should return investment cash to shareholders. Should they do that through a standard dividend, maybe a special dividend, or should they do that through a share buyback? Well, of course, the thought that goes behind that has to look at the valuation of a company share relative to how they understand the worth of the company. And if the share price is trading very cheaply relative to the worth of the company, then arguably it is a logical thing for a company to buy back its own shares. So I think it reflects that value opportunity. It's also a more tactical and flexible approach for companies. Historically, dividends have been seen really as upward only, that the payment for dividend in year one, the company would then aim to at least to match that in year two, but arguably try and increase it. So they try and have a steady progression over time. That expectation doesn't really exist with buybacks. So a buyback can be highly tactical. You can have a buyback in 1 year, but no great expectation that it will follow through the following year. So it is quite understandable why companies might look to try and have that. It's also a reflection of how buybacks are more common in the United States. Dividend yields are pretty low. There's a good number of companies that barely pay any dividend at all, and companies are much more opportunistic in America in terms of buying back their shares. So I think it's partly a more international approach as well. In terms of where we stand, we're really pretty agnostic on the mechanism of returning that surplus capital to shareholders. We're certainly not looking to choke off domestic investment. If companies can invest building new plants, new facilities, with attractive prospective returns, and that's great. They should be doing that. Maybe they should be looking at buying some of their rivals or peers. That would also be good. But if there is surplus capital, then where companies return that through buybacks or through dividends, we think companies should be able to make up their own mind on that. But for companies to have this flexibility, we think on balance probably is good for total return. It allows them to maximize future investment. In terms of our own dividend, having identified what we're going to be paying for this year, we are using £1.2 million from our own revenue to support that dividend growth. But importantly, we've got a revenue reserve of over £11 million, which is not that far off the total cost of our annual dividend. And interestingly, it's the same level of revenue reserve as previously. So in good years, of course, we add to our revenue reserve. In years where perhaps there are more buybacks or more difficult circumstances like COVID, then we're able to draw down from our revenue reserve. But those are at attractive levels still. And on page 20, I have borrowed a chart from AJ Bell, which sets out the evolution of returns from companies and how they have changed slightly over time in terms of the ordinary dividends, special dividends, and you can see that increasingly years 22, 23, maybe 24, share buybacks are becoming ever more popular and sort of a fairly mainstream way of returning value to shareholders. Finally, then, turning to the outlook, I think, as ever, there are a number of good factors and a number of more difficult factors looking at the UK economy. What I would highlight here, I think, is that the UK economy was getting off to a pretty encouraging start, really running up through to the general election in the UK. Growth was at or amongst the strongest of the G7 economies. And that was clearly positive, but it has faded. Consumer confidence has fallen, company confidence has fallen. This is despite the fact that disposable income has made some pretty good gains. A lot of this lack of confidence, I think, is because the new government honeymoon has run out pretty rapidly. And whilst understandable that they might have wanted to downplay and warn people of tax increases ahead of the budget, it appears that it's rather backfiring, that the dip in confidence is rather undermining the growth that the government was trying to look to grow. So I think there are reasonable fundamentals in place. Individual balance sheets and individual earnings are pretty robust, and the same could be said for companies as well. What's rather lacking is confidence, and it might take a while for that to come back, but actually to have fundamentals in place is a good thing. We expect that interest rates should be coming down, but clearly recent developments suggest that those are coming down a little bit more slowly than perhaps might have been thought. So the background there again is generally supportive, but just with a little bit more caution than perhaps. But overall, we feel that despite this slightly mixed background, it's really the valuation opportunity that exists in the UK that should lead to reasonable returns for shareholders. And within that, of course, we strongly believe that dividends and dividend growth should be a reasonable part of that return for shareholders. So that concludes my presentation. Thank you very much for listening. Joe, if there are any questions, I'd be very happy to take those.
Fantastic. Thank you, Julian. No, I think that was a really insightful kind of update on both the trust and the UK, and a lot to unpack as well. So I think it makes sense really to start on the valuation point. That seems to be a pretty hot topic whenever investors are talking about the UK. So I think it'd be good if you could really delve into perhaps how cheap the UK stock market actually is versus those international markets. I know obviously it sits below its own historical price to earnings metric, but in context of international markets, how cheap really is it? And perhaps drawing on an example or two in the portfolio just to provide some context for the listeners.
Well, the devil really is in the detail. There are all sorts of different ways of valuing stock markets and individual companies. I've highlighted price earnings ratio and dividend yield. Arguably they're too basic to give all that much insight, but I think partly because they are so simple and the data set is long, they are insightful. So yes, the UK market is trading below its own average. When one compares it to America, well, it really is chalk and cheese. The multiple on the S&P obviously is enormously inflated by the Magnificent Seven. But the PE on the FTSE 100, I think, is now about half that of the S&P. And that's historically, I'm not sure it's often been any wider than that. So yes, relative to America, the valuation of the UK market has rather been left behind. Relatively, Europe, perhaps less of an anomaly, but I think the economic circumstances of the UK actually might be rather better than Europe. But of course, words are one thing, and action arguably is more illustrative. And so I think it is particularly telling that companies are consistently buying back their own shares. It shows not only do they say their shares are cheap, but they're actually acting on it. And I think we've seen high levels of merger takeover activity in the UK market. And again, that would be indicative that private equity investors or companies, peer groups, competitors, are also perceiving there to be value. So not only are investors like me saying it, as you might expect, but actually within the wider world, other types of investors and other companies are really looking to try and take action there. So I mentioned the example of DS Smith. So that had a couple of bids, two of its rivals bid for it, highlighting that they saw the value there. In fact, in three of the companies that we sold last year or came out of the portfolio, all three of them, in fact, were taken over. So we had invested in the two music royalty fund businesses, Hypnosis and Roundhill. They were both taken over. And we'd also been a shareholder in LXI, the property company, and that was taken over by London Metric. So yeah, there is a high level of takeover activity, which we believe is a reflection on the valuation gap that exists in the UK.
And on that takeover reflection there, Julian, do you see that continuing at its current rate, given valuations are where they're at now, or do you see a lot of that already having happened and slowing into the new year?
Well, in many ways, we hope it doesn't happen, because often, of course, when a company is taken over, we're no longer able to invest in it. So if we truly believe that a business can generate good returns on equity and can grow, we want to continue to invest in it. We don't want that opportunity taken away from us, even if perhaps you're offered a 20% uplift on the share price. So if a company is generating good returns, we'd much rather hold it for 5 years and get 20% per annum each and every year than just to get a year one boost. So in many ways, we hope that the takeover activity doesn't continue. But of course, we'd like companies to be more appropriately valued. And at the end of the day, we're capitalists. It would be wrong of us to stand in the way of the mechanism of the market of correcting these undervaluations. I mean, I think underlying it, we can ask, why is it that the UK market appears to have this gap? The government has made some initial descriptions as to why that might be, and it's certainly true that UK institutions, particularly pension funds, hold very little in UK equities compared to many international pension funds. So if you look at Canada, Australia, or across Europe, most of those areas hold much more within their own domestic equity market. So the shareholding culture within the UK has significantly weakened. And that's also true of retail investors. Most people in the street don't hold any equities, or at least directly, and seem to have no interest in it. Whereas actually it is vitally important for the economy. So if we can get more people interested, it doesn't have to be through tax breaks, but that is one thing the government seems to be looking at, or it doesn't have to be through diktat either, through demanding people hold more in UK equities. But one way or another, shareholding culture in the UK seems to be weaker. So hopefully that can be turned around and valuations might correct.
I guess with that weakened culture, it would be good to get your thoughts on the recent Labour budget in terms of that kind of UK PLC growth, because a lot of dialogue and a lot of conversations are leaning towards that budget being on the side of an anti-growth budget. So it'd be good to get your thoughts on that. But equally, given the potentially rocky road that the current government we have now has with Trump, it'd be good to get your assessment on perhaps the prospects for the UK after both the budget and the US election.
Yes, there's a lot to cover there. So the Chancellor had been on record as wanting to be the most pro-growth government ever. If it was a school report, I'm not sure she'd get high marks for achievements so far. I think, trying to clutch a little bit of a straw here. It may be that the government and the Chancellor are somewhat chastened by the response. Maybe they just hadn't anticipated or calibrated how to perform. After all, they've not been in charge before, and I think one shouldn't underestimate how fantastically difficult a job it must be. And so that's a little bit of a defence for them. And perhaps the guardrails are now going to go up in terms of recognising that companies and the economy won't take any more tax rises, and the gilt market also has responded adversely, and that makes government borrowing more difficult. So I think maybe a couple of shots across the bows there for the government, and maybe it will hopefully encourage them to go back to the pro-growth agenda that they talked about. The relationship with Trump could well be difficult, but if there's one thing we know is that he's quite prone to changing his mind many times, frequently, backwards and forwards. So to try and guess where we're going to end up, if anyone can ever end up in such a situation where things turn around the whole time, it's pretty tricky. So we're certainly not looking to reposition our portfolio as a result of either the budget or Trump. Quite possibly it will result in more growth in America. It will certainly be more domestically oriented if he carries on and follows through with the tariff talk. Interestingly, I think UK exports almost the same amount to America as it imports. So in some ways it's neutral. Yes, it's a large trading partner, but we trade much more with Europe. Europe is more important than America. And our portfolio is very international, as you know. So we'll have to see how that evolves. But it's difficult to say where we're going to end up. But think of the margin, as you were suggesting. The developments are not as positive as they could have been. They are a slight dampener, but I think probably a dampener on growth and expectations rather than cancelling it altogether.
Interesting. No, that's a very good point. And I think steering back now to the trust, you obviously mentioned that portfolio, the positioning is largely not going to change because of that. And that very much, I think, is reflected in your bottom-up approach. So it would be really good if you could go through a little bit on what you look for, what traits you look for in particular stocks within the UK, and perhaps some areas of opportunity, even those down the market cap scale.
Yes, good. Well, the portfolio is very much built from a bottom up. We are looking to find individual companies which are attractive, and then we'll have a collection of those, and that becomes a portfolio. Of course, it's diversified, so we're looking for maybe 40 to 50 of these strongest, best companies that we can find. We're also aware clearly that the world is full of uncertainties, and that we need to have diversification across there by company name, hence the number of stocks, also by sector, and also partly by geography. So yes, the UK is the largest part, as you'd expect from a UK focused fund, but we have geographic diversification as well. So in general, the characteristics of the company that we're looking to invest in would be they can generate attractive and stable growing return on equity on their own business. So that might be indicated by perhaps an attractive gross margin and operating margin, as well as feeding right through into that return on equity. Ideally, that would be combined with some growth as well. After all, if a company can generate good returns and growth should be even more valuable. And we believe that compounding effect over time can be very, very powerful. All of that needs really to be combined with strong management. So we look for management teams who are tied into the business, incentivized to run the business the right way, and who also own meaningful amounts of equity in those businesses. And all of that to be combined with an attractive valuation. As those slides earlier tried to highlight, valuation does matter. So it's possible to invest in a really attractive business, but if you pay too much for your investment at the outset, then the returns will always be compromised. So ideally, first-class business, good growth, good management at a low valuation, or failing that, just a sufficiently attractive valuation. So it's not just about finding a company valued with a price-earnings ratio of less than 10. It's not just about the multiple that you pay for, it's about the quality of the business underneath. So a prime example of this would be to look at Intermediate Capital, which has grown to become our largest investment. We've held it for many years. It's grown and evolved its own business over that time. It used to just invest its own balance sheet, its own worth. Because it was doing that well, it became a fund manager. Other people gave it money to manage, and that is now the largest part of its operation. It's grown from just investing in a particular niche of private debt across Europe. It now invests across slightly wider asset classes, but worldwide, and increasingly in America. So it's taken its core expertise and has developed it sort of vertically into slightly different areas, still in private investment world, and then diversified geographically as well. So that would be a prime example of a company which has more than fulfilled our hopes for it when we invested initially.
Fantastic. And in terms of the portfolio characteristics there, Julian, I know you said it's not all about valuations. You need to make sure that underlying quality is still there. Would you know the kind of average price to earnings across the trust, and perhaps some metrics which help define that quality, whether it's return on equity to help showcase that superior growth, or debt perhaps carrying less leverage than the broader market?
Part of the difficulty of looking at all these metrics is getting reliable enough data. So it's definitely characteristics that we look at when we buy it. And for example, one confusion would be around whether a company is leasing its property or whether it owns its property, and that can change the metrics materially. In terms of valuation, we feel that the portfolio is valued at a slight discount to that of the market. But of course, the market's own valuation is really quite distorted by some of the UK's own mega cap sectors. So what's happening in the oil sector, the price earnings ratio of BP and Shell moves actually quite a lot depending on what's happening to the oil price, and then that impacts on what happens to the market. So we feel that the underlying earnings of our portfolio is rather more stable than that of the index as a whole, and is a higher quality. Comparing it to any one particular point in time can be slightly misleading. We're also looking for strong balance sheets, so we would look for companies that are less leveraged than the average. I mean, encouragingly, UK companies as a whole, largely in response to COVID, are really not that highly leveraged. Obviously, having gone through that economy heart-stopping moment, companies had to repay a lot of debt. They had to get themselves into a more stable position, and that has largely continued. So individuals and companies, both financially, are in a pretty good position relative to history, and we are looking for companies that are appropriately financed, and we would suggest that having less leverage is generally better.
Brilliant. And I think a nice way to kind of round this off, Julian, would be your thoughts heading into 2025. Have you got any ideas or thoughts and opportunities moving into the new year?
Well, I think there are a good number of opportunities in the market. Most of those, hopefully, we already have. We don't have a high turnover mentality. We're looking to invest in companies as owners for the long term. We're certainly not looking to trade frequently. So we will undoubtedly be making changes to the portfolio as opportunities appear, as valuation that appear attractive for companies. And so far as the economy and the stock market goes, I mean, barring any large shocks, we would rather expect it to be steady as she goes, that there will be hopefully steady earnings and dividend growth progression to come through. And when we're starting off pretty undemanding multiple, there's every reason to expect that should then flow through into progress for the stock market and for companies as a whole. I'm sure there will always be interesting individual opportunities. We highlighted just how volatile some share prices are earlier, and I'm sure there'll be some opportunities like that to come along during the course of the year. So undoubtedly interesting times ahead in terms of geopolitics, but it is very interesting over long time periods to realize just how different stock market performance frequently is to what happens at an economic level or regardless of what's happening geopolitically. It's the old adage, it's about the amount of time that you are invested in the stock market rather than short-term timing in and out.
Absolutely, and I think, yeah, to echo that, that's exactly the way to look at markets, and it certainly is an interesting time in the UK at the moment. So with that, Julian, I just want to say a big thank you. I think as we've come to the end of our time, and I think that's been a really, really good update, actually, and some insightful answers on those questions. So very much appreciated. For those listeners on the call that want any further information on CT UK, Julian and the team have some very high quality information, on their website, both trust related and also insights and outlook on wider pieces as well. So you can go check that out. So with that, a big thank you to those who've dialed in this afternoon, and also Julian for joining today. It's been very much appreciated.
Pleasure. Thank you, Jay. Thank you everyone for dialing in.
Cool. And yes, we hope to see some of you on our last webinar of the series next week. But with that, thanks to everyone who's dialed in, and have a great weekend when it comes. Take care.